I'm going to pay you $1, but I'm going to get 45 cents back. That is what we call negative gearing. And what is the actual purpose of negative gearing? I'm your host, Tony Shah, and thanks for joining me on another episode of the Mortgage Chat. So you probably hear a lot of people talking about, hey, do you know what? I need to find ways to reduce my taxable income because I just pay too much tax. But what is the main purpose of negative gearing? And what is the main purpose of investing in a property to get a bigger tax refund back to reduce my taxable income? Well, first of all, what is negative gearing on an investment property? So let's break it down a little bit more, okay? So let's just say the total expenses on my investment property is $30,000 for the year. So call it bank interest, property management fee, repairs, council rates, water rates, insurances, etc. Okay, but my rental income is only $20,000. So therefore, there's a shortfall of $10,000 where I have to pay out of my own pocket every year. That $10,000 is what we call negative gearing, where I can claim back the tax refund on that portion. So for example, if my taxable income is above $200,000, my tax rate for anything above $200,000 is 45%. So for that $10,000 that I've negative geared in cash outlay out of my own pocket, I get 45% of it back at the end of the financial year in tax time. So which that means I get $4,500 in my bank account. So negative gearing, unfortunately, in these days, especially when you're going to borrow 100% of the purchase price plus cost because you've got a lot of equity, or you're only going to borrow 80% of the purchase price, you're still going to be a negative gear because the rental yield right now is actually quite low in comparison to the rate that you're paying for your loan and after expenses and all that. So for example, even if you're borrowing 80% at 5.8% or 5.65%, whatever you want to call it, and your rental yield is only 5% grace yield, well, you're still going to be negative geared, okay? So if you're going to negative gear, make sure you have a good asset or you buy an asset that grows significantly, that outweighs the cash outlay after getting your tax return back, okay? Now, a lot of people buy shit assets that doesn't grow, but they're negative gear, right? So for example, people buy apartments that hasn't grown in the Western Sydney area for the last 10 years, okay? So they still want to buy an investment property, an apartment, 1, 2 better, you can call it, Western Sydney Blacktown, okay? Which hasn't grown the last 5 years, but it's costing you money. Yes, I'm getting a good tax return back, but you know what? I'm still outlaying that 55 cents, but my asset doesn't grow. So really, what am I doing? I'd rather just pay that 45 cents tax and get that 55 cents back in my own pocket, okay? Because I'm holding a shit asset. So the reason why I want to do this video today is because I want to show you negative gearing is not for everyone if you can't afford the cash outlay, especially if you're going to buy a shit asset. It's only sufficient and it's viable and it's doable, and you only want to do it if you buy a great asset, okay? So what I'm going to show you is I'm going to show you a great example of one of my properties that I purchased in Baulkham Hills, Sydney, New South Wales. I'm going to show you my expenses, my rent, my tax return back, my tax refund back, and how much it's going to cost me per year, month, and week, and also how much it's grown the last 9 months since I purchased it, okay? And why negative gearing for this particular property was worth it for me, because I'm going to move into the property in the future. Okay, if you're only listening to this podcast, please just jump on YouTube and watch this part of the video, because I'm going to show you on Excel spreadsheet what I've done for this property and why this property is worth negative gearing. So let's get cracking. So thanks for joining me on this second part of the video. So like I said to you, if you're only listening to this podcast, please jump online, look at this part of the video for you to understand the breakdown of this investment property that I purchased last year. Okay, so as you can see here, I actually purchased this property for $2.05 million. All right, stamp duty cost me $95,000 and some change. Solicitor cost $2,000. So I was all in on just under $2.15 million. All right, now my bank loan is 5.65% at interest only right now. So I'll borrow the whole amount because I use my equity to fund this investment property. So I've essentially borrowed 100% of the purchase price plus cost. So at 5.65% on the total loan amount, my interest for the year is $121,333. Hey, how nice is that? So that's my cost. That's my cost on holding this property. All right. So over here is my rental income. Okay. So I got a front house and I got a granny flat. The front house is leased for $770 a week. Okay, the granny flat is $580 a week. So my total weekly income from that property is $1,350. That's a total of $70,200 for the year. Now, obviously, that's just gross rental income. Okay, I've got to work out the net rental income now. Okay, which I've accounted for 25% for expenses, and that's about right what I've encountered since I've purchased this property. Okay, so around 25% expenses, like I said, property management, insurances, council rates, water rates, and a little bit of repairs. Okay, so I've taken away 25% as an expense, so I'm left with around $52,650 from that $70,200. All right, so this is where I've negatively geared. My interest minus my income after expenses, I'm actually geared at $68,683.92. That's how much I'm forking out of my own pocket up front, guys. So I'm on a higher tax bracket at 45%. Okay, so therefore I'm going to get 45% back at the end of the financial year, which is just under $31,000. Okay, now as you can see here, my net cash outlay from holding this property now is that minus that is just under $38,000 a year just to hold that property. Okay, after negative gearing benefits. All right, I haven't accounted for depreciation. Okay, which is only a few $1,000s, but I'm not going to bring that into the calculations. Okay, so my holding costs after negative gearing tax benefits back is just under $38,000 a year, which is around $3,148 per month and just under $730 per week. Okay, now for most people this is not sustainable, but like I said to you, I can sustain this because I have no non-tax deductible debt. Okay, which is my owner occupied home loan, which I've paid out a long time ago. Well, not a long time ago, but let's call it 4 years ago. Okay, so why do I negative gear so much? Okay, well, let's look at what the valuation of this property is now. I've done the valuation with Bankwest and I've done the valuation with Macquarie Bank, and I purchased this property in April 2025 and I settled on it in late May 2025. So right now is January. Okay, so it's only been around 9 months, and Bankwest valued it at 2.227. Macquarie Bank valued it at 2193. In 9 months, it's grown by $177,000 as per Bankwest valuation. Macquarie Bank, $143,000. So my net growth, which is that minus my gearing, $139,000. Mac Bank, $105,000. But I'm happy with this. In 9 months, my wealth just went up by $105,000. If I annualize it over 12 months, this will be around $135,000, $140,000. So therefore, this is why it makes sense to negative gear this property, okay? Because I'm buying a great asset where the growth rate significantly outweighs the holding cost of the property. Now, if you think I'm full of shit of these valuations, well, let me show you the valuation. So look it up here. Like I said to you, I purchased for $2.05 million. There's my name right there. There's Balcombe Hills. I signed the 666W. If you're in New South Wales, you know what that means. In April 2025. There you have it. Bankwest, 2227, right? Valuation date, 7 January 2026. So no bullshit there. Macquarie Bank, right? We're at 7th of January 2026. 2193, no bullshit there. So that's why I say to everybody, sometimes you will only negative gear and buy asset to reduce your taxable income only if the growth of that asset significantly outweighs the holding costs of that property. So there you have it. That is a prime example why I negative gear on this particular property, or why other investors out there would negative gear on such high valued properties, okay? Because the growth of this particular property significantly weighed the cost of holding it. And do you know what? I only do it because I've paid off my home loan, I can afford the negative gearing, and I can afford the cash flow. I've purchased a high valued property because I have a lot more disposable income to play around with my investment journey from now on. Now, if you want to see how I've paid off my home loan in less than 10 years, here's a video up here on YouTube, and also how to build an investment portfolio. Here's another video. So there you have it. I hope you enjoyed this video. As always, if you need help, if you need a strategy session, please book a time in and let's get cracking.